Hey everybody, this is Paul Horsley. I'm with Dave Forbes, the one and
Hi,
only.
everybody.
It's the Financial Prodigy. It's Money Monday. We're excited that you're here. Hope you had a great 4th of July.
You all have to admit, especially up here in the upper Midwest, that this was one of the nicest 4th of Julys we've had in a long, long time. It was warm, but the weather was just beautiful. Nice full moon and every night. And
It's just been beautiful. Even in the city, it's been beautiful. That moon, it's just an amazing thing there.
Yep.
I love it.
All right. Well, first off, our apologies for taking a few weeks off. Paul and I, our schedules kind of come and go. We have these concentric circles of schedules. Last week, Paul had an opportunity to go up to the Boundary Waters with his son. So we said, well, we'll delay it another week. And so here we are. We're going to try to do this every week, but sometimes we don't. I'll let you guys know. As you know, you get the emails and explain what's going on. Also, if you haven't had a chance, look at our website. I've been slowly updating the website. We record these. It takes me a day or two to edit them, and then I throw them up on YouTube, and then I have a native version in Vimeo that goes up on our website, and so they're there for us. The new website, we're trying to make it as simple and clean as possible, so all you need to do is scroll down to the bottom where it says resources, and it'll take you to the videos page. It'll also take you to the banknotes page and all those other things. When I do post the stuff on YouTube, it automatically posts it to Facebook, our Facebook page, and our LinkedIn page, and our Twitter feed. So if you miss it, you can get the condensed version. I do a little editing. You'd be amazed in the edited version how little Paul and I say all the time. So anyway.
I never say that.
I'm getting better at my editings. Anyway, the last few weeks we've been going through reviewing Becoming Your Own Banker. You know, we always talk about it in the fact that it's a very short book. It's a total of 92 pages long. And as we've discussed, it was written about 20 years ago, came out in 1999, and it was basically a depiction of Nelson's life and his road to discovery of how infinite banking works in his own life and how it can apply to all of ours. And to give the quick definition of it, infinite banking is basically using a dividend-paying whole life insurance policy from a mutual insurance company, an especially designed life insurance contract, to finance your life, to be your own bank instead of using commercial banks. There's a little bit to it, takes a little bit of work, takes a lot of education, and a lot of thinking differently about how we operate our lives. Both Paul and I discovered this many years ago and started applying it in our own lives before it was really widespread discussion about it. Back in the day, there wasn't YouTube and the internet to share these ideas with. So you basically, read Nelson's book. You wrote letters back and forth to Nelson and the guys at infinitebanking.org and got up to speed on it. And it really wasn't until about 6 years ago that Nelson and the other guys at infinitebanking.org decided to trademark it and train infinite banking practitioners on how to design these life insurance contracts primarily, and then secondarily, but it's also become more of the primary function, to educate their customers and their clients on how to implement and use these policies. The basics behind the policies is that you're going to use it as a bank and you're going to borrow money from it and pay money back and those type of things. But we're sometimes users of the infinite banking process struggle as they get bogged down in the day-to-day of how to operate it. So starting with this week and then our next session, I'm going to kind of give a quick overview of how we create a bank, our own internal bank, and then next week is going to be the actual nuts and bolts of how we operate it, how we actually use separate accounts to use as a clearing, say a quote unquote a clearing account, and then use it to pay down our debt while the money still works within a policy to the point where it becomes our own money machine. So the chapter, creating a bank like the ones you already know about, starts on page 19 of Nelson's book. And the first thing I thought is, what do banks do? They take in deposits and they lend money. Okay, do they lend their own money? No, they don't. What banks do is they take in a deposit and then they turn around and they pay the depositor rent for his money. They pay them interest, and then they turn around and lend that money out at a higher interest rate to people who want to borrow money. Seems like a simple enough thing. They're a middleman in the transaction. Banking regulations are fairly strict. It takes a little bit of capital. You have to put in, if you want to own a bank, you have to put in a little bit of your own money. But the magic thing of a bank is that when they take in $1, they can turn around and lend it out, and sometimes they can lend multiple factors of it out. Adam Smith, who wrote Wealth of Nations, he was a Scottish economist back in the 1700s, also wrote a book called Paper Money. And it was up until that point, and he wrote that, up until that point, most money was not paper. It was gold or silver. It was precious metals and stamped coins and things like that had actual intrinsic value that you would use for barter and trade. Paper money became a thing in the mid 1700s when banks started issuing paper that you could turn around and hand in for gold or silver. This is a very simple comment that he made, though, as a banker cannot make a loan unless he has a deposit. And preferably bankers don't want to use their own money to loan out. They want to use depositors' money to loan out. They are just the middleman. And that is what we have to think of when we are designing an infinite banking policy, is exactly that. Is our infinite banking policy is the middleman. The money comes in and it goes out. It pays us interest. We deposit it, and then we also use it to loan it out to ourselves to finance our lives. One of the crazy things in the United States is for every $1 that a bank takes in deposit, they can lend out $10. So if you go and deposit $1,000 into your local bank, they can turn around immediately and lend that out as $10,000. And so if you look at the way that this stacks on top of itself, your $1,000 comes in, they're paying you 1%. It goes out 10 times at 3%, which is a 200% rate of return on each of those loans. And they collect that, and they collect the difference. That's how come the biggest institutions in the world are the banks. They're sitting on a pile of gold, and that pile of gold is supplied to them by us as depositors. And they turn around and they leverage it. It's really an amazing system based on nothing other than the promise of the borrowers to repay the debt and the collateral that is put up as part of the loans. Nelson referred to it as the world's largest con game, basically because they're lending, when they're lending out $10 more than they have nothing to back it up with. Those of you who remember a couple of weeks ago when we talked about Nelson's beginnings were in forestry. And there's a part in the book that when he talks about cogeneration, and what he observed in his days of forestry is that companies that ran sawmills and forestry operations figured out a way to use their excess and scrap to do other things with. And when he said cogeneration, what he meant is you cut down trees, you drag them into the sawmill, you saw them up for boards, and you sell the finished product as boards. What happens during the actual manufacturing process of boards is that there's sawdust generated from cutting them up. You scrape the bark off the trees, and initially it was just thrown away as scrap. But what they found out is what is a great thing about sawdust and bark is it burns. And if you think about power, when we have a power grid, power is generated by either coal burning or gas turbine power plants. Nuclear power plants are basically giant water boilers. I mean, you take nuclear power and you heat up water and use the steam to spin turbines around to produce electricity. The same with hydroelectric, the same with coal-fired and gas power plants. Most sawmills in the United States have what they call a cogeneration plant. And what a cogeneration plant does is it takes the scrap that would otherwise be thrown away, and they light it on fire, they boil some water, and it spins a turbine around and produces electricity. They basically get free electricity from their scrap. It's cogeneration. And when Nelson got into the insurance business, he looked at that, which was a basis of a lot of how sawmills made extra money, was they could cut back on their utility costs by using their own byproducts and reducing those costs, thus increasing their profitability. Okay, so cogeneration, he looked at insurance policies as the same thing. Is when you have an insurance policy, you're insuring a life. You have a death benefit. But you also, as you deposit money into it with the dividend paying whole life insurance policies, guess what? You're also earning and growing your cash value. You've got cash in it. And so you're doing two things with your money. You're insuring against an untimely death, but also growing your assets. He said, so that's the cogeneration process. And you add to that the ability to borrow money from those policies and do other things with it while it continues to earn interest, adds to the cogeneration effect that he was talking about. And that's what we're always trying to get, is we're trying to get a way that we can have the dollars do more than one thing. If you're not practicing infinite banking, you are taking money in, whether it's from your job or from a business or from other sources of income you have. It goes into a commercial bank, and you start paying your bills. You have things that are financed, you have things that cost money. And what you're doing is you're paying the bank to be the middleman, and the money goes in one end and comes out the other at a much less percentage. You could be doing the same thing with your own cogeneration plant. The money comes into your policy, comes out the other side. What comes out the other side you use to pay down debts and finance your life while making the full circle, all keeping it within your system. But once it's deposited into the system, it's always earning a dividend. And once a dividend is declared, it's there forever, and it increases the value of the policy. That's what he meant by cogeneration. We want to have a cogeneration plant for our own money is what we want to do. He also talked about something called economic value added. It was brought up in a Forbes magazine article, and I don't remember, it was quite a while ago, in the early 90s. And what happened was, in the early 90s, companies started accounting for their own internal cost of capital differently. What they discovered was, up until that point, was they would account for a cost of capital as when they would borrow money from a bank outside or an outside source. If they took out a loan and they had to pay 5%, and that 5% was a cost of capital. But what they didn't do was look at their own internal capital, that was money that was just sitting there internally, and apply a cost of value to that. If the money wasn't earning any interest, it was actually losing them money. There was no value added to the capital that was sitting in the company. And so there was a big change that came out with economic value added, is that companies were literally forced internally, they forced themselves to start looking at internal capital as something else that they could co-generate a better return with. It didn't just sit there as cash. If the cash was sitting there and it wasn't to be used in the short term, and it was used put away for longer term projects and other things, they needed to go earn a return on it short term that could then be co-generate and add to the bottom line of the company. The concept of economic value added is something that, as infinite bankers, we want to be very aware of. That is, our money just sitting there earning 1% in a bank account? Is it sitting in a mattress? Is it sitting somewhere else? Is it in the market, but not with a guaranteed rate of return, when it could be have an economic value added within an infinite banking policy, plus it could be doing something else? Does it have an economic value added to it? One of the differences of owning your own bank versus using someone else's is you put money into a commercial bank. One thing you do lose is control of your money. If you ever look at a deposit slip, when you pull up to the deposit window at the bank and hand them your money, whether it be cash, a check, whatever, you hand it with a deposit slip and then they hand you a receipt back. That money technically is not your money. The bank is promising to pay you back what you've just deposited, but you have lost control of your money at that point. We haven't had any runs on banks in a long, long time due to just the regulations and back stops that the government provides. But the problem there is you have lost control of your money. What you want to do is you want to be the owner of the bank. The owner of the bank has the control. Well, when you're instituting an infinite banking policy, you are the owner of the policy. The policy is a contract between you and an insurance company, and the insurance company does its due diligence. And how do they do their due diligence? They hire engineers that are called actuaries that basically look at pools of people, common ages, if they're common sex, and common health backgrounds. And they use basically long-term prediction to say this pool of people at this age and this health on the average will live X number of years. And the insurance company then the actuaries hand it over to the rate makers. Rate makers then say, okay, if we need to pay X number of benefits at the end of this person's life, and you say that this person is going to live X number of years, it's going to cost us Y number of dollars every year to cover that. At the end of the policy, we will have enough money to pay them the death benefit. Like anything in engineering, it's always grossly over-engineered. If they think it's going to cost you 80 cents a year to insure a person, they're going to tell the rate setters are going to say it's going to be $1 or $1.05, because they do not ever want to run short. Reason being, and this goes back to the safety of dividend paying life insurance policies through mutual companies that we use in infinite banking, is there are no shareholders to go get more capital should they run short. The shareholders of the company are the policy holders. So there isn't a ready source of capital outside the companies. They have to plan very long term, very conservatively, so they will always have enough money to pay their death benefit contracts out. Like all engineers love to over-engineer everything. Those of us who are in the aviation business, every airplane we have has a red line, we call it, the max speed that the airplane can fly. Well, we all know that any airplane you fly, if you hit the red line, it's not going to come apart. You get 20 to 30% higher than that before bad things start to happen. But the engineers want to over-engineer everything. Works the same way with our infinite banking policies. You know, if they're telling you it costs $1 to insure you, it really costs 80 cents. But they want to make sure that in the fluctuations over a policyholder's life, an owner's life, that they will always have enough money to pay the death benefit out. What happens every year is the senior staff of the company gets together and says, okay, we took in $1 for John Doe's policy this year. How much did it really cost us to insure John Doe? And they'll say, oh, it only cost us 70 cents. Well, we have 30 cents left over. Let's put a little bit aside in a contingency fund just for a rainy day, just to make sure we're safe. And let's return the rest to to John Doe in the form of a dividend. Dividends then are basically a return of capital. In infinite banking, what we do is we reinvest those into paid up insurance, which accelerates the growth of cash value and also buys you more insurance. The trick with that is that when we say a dividend, we get confused because we say, well, wait a minute, dividends are taxable. And unfortunately, it's a misnomer because insurance companies have been around much longer than the tax code has been around. And insurance dividends are not a taxable event. It's a return of capital. So there's no tax paid on it. It rolls back in the policy and buys more insurance and more cash value. So anyway, but getting back to the owner benefits, was the control of the benefits, control your money. The next thing is liquidity. I talked a little bit about when you give your money to a bank, yes, you can pull it out, but all of us know if you have $50,000 at Wells Fargo and you want to go take $50,000 out tomorrow, are they going to just hand you $50,000 at the teller desk? Absolutely not. It depends on the bank, but most banks have rules that they limit cash withdrawals to $3,000 or $5,000. And it usually requires a senior officer of the bank to approve it. The difference with the liquidity with an infinite banking policy is if you have $150,000 of cash value and you need $150,000, you either go online or make the phone call and you have that money immediately and you have full liquidity of it. Control and liquidity, two things you don't have with a regular bank. And then there's the risk. With a bank, you're FDIC insured. Bank goes under, the government's going to cover your deposits 100%. Sure they will, up to X number of dollars. I'm not sure what it is these days. Is it 200,000 or 250,000? Problem with that is how long will it take you to get your money back, and will you get it all? There has been some rule changes to bank bailouts since 2008, which makes that even more difficult. Insurance companies are utterly risk adverse, especially the highly rated ones that all of us use for infinite banking policies. And so with that risk, or the lower risk, insurance companies are abhorrent to risk. So they want to make sure that their money is going to be coming back to them for 100 years usually. And so the risk there is on the insurance company. It's not on us. When we start our bank as an infinite banking policy and we sign the contract with the insurance company, which is our policy, the insurance company is taking all the risk. They are guaranteeing you a death benefit at the end. And if they run properly, like the ones we do use, a dividend annually, but they are taking the risk. We are not. It's just the opposite in the market where basically you're taking all the risk and those who are handling your money are taking their cut, whether or not you ever actually make money or not. They're going to get paid either way. So what we're trying to do basically is bring those things that are creating risk and taking control away from us and not being truly liquid when we need it, and bring it home where we are controlling it. We want the control, and that's what we really want to do. So it gets back to what I talked about last time we got together, is it takes a way to change your thinking. And I know that, and what I'm trying to do in these discussions we're having on Monday nights is exactly that. I am trying to get you to change your thinking, and it's very hard because we are hardwired to get a paycheck, put it in the bank, pay our bills. When we want a new car, we go get a loan. When we want a house, we go get a mortgage. And we're trying to set up a system to remove ourselves from that. So by changing our thinking, what we're doing is we have to know that we are the bank. We have to have our dollars that work in a savings account for us and only us. And that when we need to borrow money, we borrow it from ourselves and pay it back to ourselves the whole time while our money continues to earn interest. Like I always call it the proverbial sweatshop for dollars. That's an overview of what we're going to do. And I'm going to go to questions here in a second. But what I want to stress is when we get together next time, Paul and I are going to talk about actually how we manage policies. We got a little taste of it a few weeks ago when Nicholas St. John was with us, and we discussed how we set up the software to model loans and then look at paying down debt. And a lot of that comes is we figure out what your plans are, what your goals are, and what you need to do. Because some people want to be out of debt, some people want to retire early, some people want to make sure they've got retirement income for until they turn 100. Every person's different, just like almost every policy is different. And that's why when we apply for these things. But what we want to do is show you how, and we will do this next time because it's a little bit more involved, of how we basically set up a clearinghouse account and we start picking away at the debt in our lives and make it basically nip one thing after another to where at the end, 8-10 years down the road, you're basically paying off your mortgage with a policy loan. You're still making your payments, but you're making them to yourself, and the whole time your cash value is growing. So on that note, I'm going to say, are there any questions? Paul?
Hey, I just want to touch on the EVA, the economic value added. That's a good point. And to kind of make a comment to that, let's just say that you want to go build an addition to your house, and you've got a policy, and or you don't have a policy. It's one or the other, and how you utilize that. But let's say you want to go. There's several ways. You can either pay cash for it, or you can get a loan for the addition, right? And so if you do that, you're paying more of your money out to the bank in interest over time. You have the addition done, and you're utilizing that through your life. If you dial this infinite banking thing in with EVA, economic value added, and you incorporate an IBC SDLIC policy, and you borrow the money from the policy, you pay your contractors, or however it works, for the product, you create this addition to your house. Your policy is still growing every year with every penny that has ever been deposited, that gaining interest and dividends and multiplying on the principal itself. And you have the product too. If the other way around, if you took your money or if you took cash and or took a loan on that and built the addition, your money is stuck in that addition, and you're giving interest to the bank, strapping yourself and not being smart at all with your money. That money could be utilized so much better when it's running in at least two places all the time. And that's one of the huge attributes of the infinite banking concept, and the power of the policies. They're just...
And that is the key. It gets back to control and liquidity and risk. The insurance company is taking all the risk. You've got your money is 100% liquid.
Yep.
You never have to file a loan application. You have to do that, and then you can control it. Usually if you go to get a loan for an addition to your house, what's the bank going to do? They're going to put a second mortgage on your house. Whether that's what a HELOC is.
Yep.
They're going to say, oh, by the way, yeah, you have to pay this back, but if you don't pay it back, we're going to come snag your house.
Yes. You're on the hook, and you're on the hook for payments in their terms. And
the money never comes back to you. It goes out and goes back. And we harp on this a lot. And I know and we've been making this a very slow process as we've been trying to educate everybody here. But I can't stress enough that you put the money in, there's the death benefit. That's a big deal. It's a machine that's going to take care of your family should you get run over by the turnip truck. But that money is there growing every single day. And you borrow against it, you use it as collateral. And yes, you're going to pay it back, but it's within a closed system that is a very well managed system. When I was talking about mutual insurance companies are a strange animal because they cannot go seek outside funding. Their capital comes from selling insurance policies. Their policyholders are the shareholders. So they have to make very, very, very sure that everything they are doing has a extremely long-term horizon. It used to be 100 years. Now it's 121 years. They want to make sure that the dollar you put in today will pay out the benefit that they promise you 121 years from now. And they're very good at it. Most of them have been doing this for well over 150 years. The magic of it is you let them run their business. You let them take the risk. But what we do is then we are the owners. We control the policies. We control the money. We use it within their ecosystem as our own bank. And the whole time it's sitting there, what you're not really thinking about, you're not thinking about death benefit, you're not thinking about interest rates, you're thinking that my money is just sitting there earning interest every day. If I borrow out of it, it's still earning interest.
Greg has a question. He wants to know, can you explain how the Federal Reserve works? Are you in favor or not of the Fed?
Not,
yeah. But not.
But, two things, not Fed and 401 not okay.
Yeah, no, right. That's so true. The Fed, here's the way the system just, if you know how a system works, you can work within its boundaries, so to speak. And that's what we do with IBC. The system is set up. We're just trying to extract ourselves from the system as it currently is. I mean, why use somebody else's money if you can incorporate yours and just keep turning it around and always grow it no matter what, and use the insurance company as your own personal banker? It's just amazing when you can do that. So how does the Fed work? The Fed is The Fed is an entity that is unencumbered by the government, so to speak. It kind of goes, it's kind of got a sister in the Treasury, the United States Treasury, but the Fed and the Treasury, they kind of works hand in hand, sometimes opposite of each other. The Fed creates money. If I were to ask you how much actual currency, like physical money, is in the world, United States fiat currency is in the world right now, the true answer is about $4 trillion. The money that you could put in your pocket, that's all that was ever created. Every other penny that's been created, United States or otherwise, whether it's any other fiat currency, has all been loaned into existence. Every bit of it. So you see the $27 trillion of debt that we have right now, that money is not part of the $4 trillion that I talked about. It's all money that has been loaned into existence. And then you get into fractional reserve banking, which is an extension off of that. And Dave kind of touched on it earlier, where, there's a 10 to 1. That number could be anything. It could be 20 to 1. It just kind of depends on whether the government wants to speed up or slow down the economy, and they kind of direct the Fed. And sometimes the Fed just runs independently, trying to help accommodate what the government, the government as it's running, the current administration wants. If you make that like a 10 to 1 or 20, if you go to 21, you want to speed up the economy. If you want to slow it down, you back that number down so they can't loan as much. So there's not that much liquidity out there. The fractional reserve banking part is just amazing because, they go to the bank and they put $1 in the bank and they could turn right around and loan out $10, $20, and it's all just loaned money. It's not even real. It's just digits. And then that money that is loaned out, go pay for a truck or a house, you turn around and that money is deposited into banks, which can in turn be fractionally
back around and lend it back out at a factor of 10 or
10 or 20 or whatever the number is. It's just absolutely crazy. There's hundreds of trillions of dollars in US dollars in the world as the world's fiat reserve currency, which is a whole nother conversation.
It is. And I'll real quick, there's 2 books out there if you want to do a deep dive. Dave's light summer reading list is, but one of them is really good, and you've probably heard it. It's called The Creature from Jekyll Island. You can get it on Amazon. It's all about the history and the founding of the Fed. And, we have to live within the constraints of it because we're citizens of the United States. We live here and it's part of it. But part of infinite banking is try to remove as much of our lives away from that quasi weird world of the Fed. It's a great book. And there's another book out there by an economist named Murray Rothbard. It's called, is it The Case Against the Fed, I think?
Yep, I think that's right.
I will post them up on our website with some links in the resources page. But there's
another really good book, Dave, out there.
What is it? Oh, yeah. Why the Rich Don't Die Broke.
It's this one. No, wait, it's this one right here.
Yeah, right.
That's why. Make sure you haven't read it. Make sure you get it. You can get it on our website for free, or you can go to whytherichdon'tdiebroke.com and get it and order it. And it's on Audible too. You can go and get on Audible and listen to it. That's even better.
But anyway, I hope we're gonna wrap this up, Paul, because we're at 45 minutes. My job is to tell you when it's time to wrap up. But I appreciate all you guys checking in. I mean, that this is really nice, and I hope we're kind of learning, going down this journey together. Paul and I talk about infinite banking daily, multiple times a day. And this is a good exercise, even for me, to go back into this book and just kind of bear down on a lot of the basics and start over again, because it's a mindset that it's very easy, because you're getting so much noise from the mainstream media about, how to invest your money. And, oh my God, you should be doing that. And especially now with the market going insane, it's like the shiny object thing, or squirrel, here's this. But infinite banking gives you a great foundation for all this, to get you set up in a conservative system that you have the control, liquidity, and limited risk. And if you want to take a loan out and go buy, Amazon call options, you can do that. I mean, and if you think you can get a return a greater return doing that. We don't talk much about that. We talk more about the basics here and the structure. And like I said, next time we get together, we're going to talk structure of these things. But then the idea is, once they're in place, is then to go look and seek those opportunities out there that will give you an extra return on your money. Besides the return you're getting on your cash value, you're taking out in acquiring other assets that are going to produce even more income. And that's all with you having the control. And that's what it boils down to. So
awesome.
On that note,
awesome, man. Well, thanks everybody for watching this episode. We certainly appreciate your time, because it is super valuable. Hope we've been helpful to you, and we look forward to seeing you next week.
All right. Thank you guys thanks for checking in. Any questions? Email either Paul or I, info@thefinancialprodigy.com. I'm DF at thefinancialprodigy.com. He's SPH, S Paul Horsley, at thefinancialprodigy.com. Email us, and we love it, and we'll dive into it as part of our next get together.
Awesome. Take care, everybody.
Have a good night, everybody.
Bye-bye.